Hello, I'm Annabel Brodie-Smith, Communications Director of the Association of Investment Companies. Today we're going to be looking at investment companies which invest in alternative assets and are looking at property and infrastructure. These type of assets can generate a higher income and are liquid, which means they can't be sold at short notice. This means they're better suited to being held in the closed-ended structure of an investment company. I'd like to introduce my managers. I've got Stephen Ellis, Manager of GCP Infrastructure.
Hello.
And Kenneth MacKenzie, Manager of Target Healthcare REIT.
Hello.
So Kenneth, can you explain what sort of assets you invest in with some examples?
Yeah, we invest in modern purpose-built care homes related to the fact that there are increasing numbers of elderly people, and we do that in market towns around the country. I can immediately think of a home in Glasgow that we probably paid 60,000 or 65,000 a bed for, and a home down in Hastings on the south coast where we probably paid 90 or 100,000 a bed. So very much localised purchase of physical assets around the country. Excellent.
And Stephen, can you explain your types of investments?
We invest in infrastructure, and specifically infrastructure in the UK. Now, by infrastructure, what I mean is assets that are important to the long-term good of society and the economy in the UK. So what that means specifically is assets such as hospitals, schools, solar panel fields, wind farms, and the like. In essence, and the defining and common thread here, is assets to which there is a long-dated cash flow supported by the UK government attached.
Right, now why are the assets good for income generation?
In our case, care homes are very consistently high occupancy. So a good care home is a long-term profitable investment for its operator, and we get a rent related to that income and are able to turn that, in our case, to a 6% dividend. So we have our homes owned for the long term with a 30-year lease, and that gives us a rental source which we turn into a dividend.
Right. So how about you, Stephen? Is it a similar situation with infrastructure?
As far as we're concerned, what we're looking at is the assets that are important. Now, because they're important and they're typically large scale, they normally have to have a huge amount of money invested to deliver them in the first place. So a hospital, for example, would be very much a case in point. So because they're important and because they're expensive, what needs to happen is that you attach a very long-dated cash flow to them. So it's long-term income generative. The second point to make is that because they're important to society, then governments tend to stand behind the cash flows associated with those assets. So as far as GCP is concerned, we only invest in the UK, so the UK government is the credit that we're ultimately looking to support the cash flows we lend against.
Right. Now, what are the prospects for your asset class, Kenneth?
Well, the number of elderly people doubles in the next 20 years, and therefore the demand for care homes will similarly grow substantially over the next 20 years. As I've said, they tend to have high occupancy levels, and therefore it's a long-term stable rental stream that we obtain. So good prospects.
Yeah, and significant demographic factor there. Yeah. And you, Stephen, what are the prospects for infrastructure?
Well, similarly, we have a demographic element here, that we have a growing population. So the call on infrastructure is growing year on year. So currently we have a national infrastructure plan, the most recent one being announced November 2014 by George Osborne, calling for close on £400 billion worth of capital expenditure on UK infrastructure over the course of the next 6 or 7 years.
Right, now these assets have been very much in demand. Some stand at premiums, namely the share price is higher than the asset value. Why is this, and should investors be concerned?
Well, it may partly be related to the fact that the net asset value is following the perception of value. And in our case, because we're paying a 6% dividend, people perceive that as long-term and stable and are willing to pay a good price for that long-term income stream.
Yes, you're giving them what they want.
Yeah.
How about you, Stephen? Do you think that's a concern?
Well, again, GCP is a highly income generative share. It's throwing off currently at today's price around sort of 6.25%, 6.5%, which, given that we're investing, broadly speaking, against government-backed cash flows, is a pretty meaty yield. So I think that there is a perception that our stated net asset value, which is applied by an independent valuation agent, is pretty conservative.
Right, so in summary, what gives your asset class an advantage when it comes to generating income?
The long-term nature of the cash flows that we lend against is the key element. I think if you're investing if you're a typical long-term buy and hold, and many of our investors coming through their SIPs, their AICs and so forth, we don't see huge amounts of churn in our shareholder register. So the long-dated nature, the absolute security of the underlying credit, being the UK government, is really the primary attraction.
Right, and Kenneth?
Yes, well, we're a property-backed product, and the properties are on typically 30-year leases, which compared to average commercial property of 6 or 7 years is 4 or 5 times the length, and therefore that gives us a stable income.
Yeah, I think it comes across the long-term nature of both of the types of asset classes.
Yeah, that's right.
So I'd like to thank today's managers. I've got here Kenneth MacKenzie, manager of Target Healthcare REIT.
A pleasure.
And Stephen Ellis, manager of GCP Infrastructure.
Thank you.
So to conclude, investment companies are particularly suitable for these types of illiquid assets, and because they can generate a higher income, they have been very much in demand in recent years, with many trading at a premium. But, as always, remember that your income and capital are at risk and can fall as well as rise, and you should not invest in investment companies if you need a guaranteed income or if you cannot afford to lose any of your capital. If you're not sure whether this type of investment is suitable for you, you should speak to a financial advisor. Thanks very much for watching, and we look forward to seeing you next time.